Hello, everyone, and many thanks once again for tuning into another of our Investment Manager videos. Many say the property sector was one of the most affected by the coronavirus and the pandemic, as funds were forced to close due to redemptions by the FCA. However, since the imminent reopening of the economy, apparently, and with regulatory restrictions on funds lifting, how has the sector fared, and should it still command a presence within investors' portfolios? Well, today I've had the huge pleasure in asking these and other questions to Matt Jarvis, manager of the Legal and General UK Property Fund, an all-round good guy. But first, before we get into the content, if you are enjoying all of these videos that we put out, it would be wonderful if you could subscribe to the channel. This really does assist us in delivering all of our financial planning and investment content to a wider audience, and it would be genuinely helpful to us to spread the word. So after all of that pleading, onto the content. Matt, it's great to see you again. 12 months ago, it was pretty much the same kind of scenario, but we didn't know what was going to happening. Looking back at last year, like I say, for many it was a bit of a annus horribilis. Taking into consideration what happened with property funds, what do you believe the regulator should learn from all of this?
Firstly, thanks for having me back, and it's really good to be speaking to you and to your clients again. And it is great in a way to reflect on where we were last year. As you were saying, it was quite different back then. We were just entering this period where the funds were all suspended, as you described. But that's a really interesting question about the regulator and what they've learned. I think it's fair to say we've all learned a lot. We've all learned a lot, not just the regulators. But it probably needs to be. We probably need to go back to March to remember what was happening at that time and why, before we can really answer that. So just to play back to that point, the valuation community at the time declared a period of uncertainty in their valuations, so they couldn't really see the values for commercial property. And under new rules by the regulator, that required automatic suspension of the property funds, as you've described. And I suppose the first thing we would say is that worked. That did what the regulators expected it to happen. They wanted that to take place to make sure that during periods of uncertainty, investors don't end up buying and selling units at uncertain prices. So in that sense, that piece of regulation worked. But I suppose towards the back end of last year, as the certainty into valuations was coming back, the real challenge, which we've all learned from it, but was a particular challenge for managers, was how to get the funds reopened again, when there isn't any vision on what investors are wanting to do, buy or sell. Now, we've been through that period for the LNG fund and for many of our peers, and I think it's probably fair to say that the reopening process has been successful. Hard, but it's been successful, making sure that we can reopen and rebalance and allow investors capital for those that wanted to come out. But I think there will have been a lot through that period for the regulators to look at and learn from in terms of how you get the funds back open again from a period of suspension. But that was all about uncertainty in valuations. But there is the other issue that you mentioned around liquidity in property funds, and that's still very much outstanding. And we're waiting to find out at this point. We're waiting to find out what the regulators have learned and what they intend to do about the future. Mm-hmm. They have undertaken a consultancy exercise. They've undertaken a consultation with investors and all of their advisors, to look into the possibility of notice periods on redemptions, effectively requiring investors to give notice if they were wishing to leave an open-ended property fund. Mm-hmm. Now, as I say, that's still we're still waiting the results of that. The consultation has been widely responded to, and I believe the regulators have been listening hard to what investors and to what managers have said about all that. Mm-hmm. But we are waiting to find out whether that is something that's going to come into force. In the meantime, the property sector is looking more positive. We believe we've done a good job in terms of providing some of the better returns from the property market over the past year, despite what's been going on. And we believe that the future is looking positive, with forecast returns of over 5% for the next 5-year period.
That has to be viewed as a positive, move forward, and kind of broadening that out. A lot of asset classes, a lot of traditional asset classes, are facing quite fundamental shifts in long-term positionings. You look at bond yields rising, you look at equities, and the apparent at this moment in time move from growth into value. Is this the case for the property sector?
Yeah, I think it's fair to say that there's a lot of shifting in terms of the long-term positioning of property portfolios, both in response to what's going on in the property world, but also in response to what's going on in the wider bonds and equities worlds. One of the reasons we are positive about property at the moment as a buying opportunity is its relationship with the likes of the bond markets. We see that there's a significant yield premium over the fixed income markets, and that naturally some of that represents the property illiquidity risk. But it is high, and we see that as a relative positive against that marketplace. But within the property world, there are a continuation of some long-term trends. I've spoken before last year, I think, about the rise of industrial and the shrinking back of the retail markets. That's something that's been going on for some time, but has been really amplified by the pandemic and how consumers absorb goods, not necessarily through the high street recently, or through the shopping centres, but very much more through internet and doorstep delivery.
Yeah,
and that's really continued this surge in occupational demand for industrial space, hence supporting rental growth in those areas, and indeed attracting a lot more investor capital into those areas, with a desire to get access to that rental growth. So industrial has done incredibly well over that period, and in reverse, high street and shopping centres and aspects of the retail market have naturally been struggling as retailers have not been able to trade, and as rental values have come under pressure as a result.
Now, history has shown that yourself and your team have been quite insightful with regards to your positionings. In many cases, being well ahead of your peers in terms of spotlighting certain certain sectors which have a greater investment opportunity. What changes are you making to the portfolio on a sectoral basis, and then perhaps even on an individual property basis?
Yeah, certainly. So I mentioned the long-term trends about industrial and retail, and those are very much reflected in the UK property fund. We have an overweight position to the industrial market. Close to 40% of the direct property is in industrial, and likewise the retail positioning is quite light. And so that's been maintained. That long-term view has been maintained over the last year, despite the fact that the fund has shrunk back as a result of reopening. We've held our long-term views of staying overexposed or more exposed to the industrial markets, which we believe will continue to perform well. So that hasn't changed much, but it's in the position we want it to be in. In terms of short-term change, the portfolio has seen a reduction in the level of offices that it is exposed to, and that's partly reflecting the current debate around the function of the office, around the need for office space, and what the future of the office market's going to be like. Now you're speaking from your new home office, and you've described to me earlier on about how that's given you sort of a different angle on how you can work, and that will be the same for many of us. We're certainly not saying that the office is dead. Absolutely not. It's certainly going to have a place and come back, but the occupational requirements for office occupiers are going to be shifting. They're going to be demanding more from the office space that they occupy. They're going to be demanding more amenity space, more flexibility, and more sustainability in the space that they occupy.
Mm-hmm.
So for the short term, on the UK Property Fund, we've been reducing our office exposure, not because we see offices as a significant risk, but it's more a reflection of wanting to hone our ideas and concentrate on those that we believe are the more sustainable buildings, or those buildings that we can turn into more sustainable buildings and more appropriate for the future marketplace. The other short-term change, if I will, would be around the residential market. So this is a part of the property sector that we have a particularly positive view on in terms of rental growth and total returns going forward. The institutionally managed residential block of flats, let's call it that, otherwise known as build to rent. So it's owning residential in bulk and leasing it to private individuals, and offering a greater level of service than might be traditionally assumed when you think about renting a flat or renting a house from a private individual. Now, over the course of the last year, we've had 2 developments take place on the fund where we've brought in this residential exposure. So we now have a scheme up and running in Chelmsford called One Canal Side. And we've last week we've acquired the North Tower of Deansgate Square in Manchester, which is a significant residential development in the very heart of Manchester city centre. So those 2 acquisitions represent about 6% of our portfolio. So it's not a significant exposure at this stage, but it's a meaningful change in direction for us to get exposure to that market, and it's one that we believe in for the medium long term.
Then finally, just to wrap up, you mentioned your longer term view on projected returns. Could you just touch on that and then possibly look at the difference? Obviously, dividing that between the yield and the capital return as well.
Well, certainly. So our overall expectation for returns from the sector is 5.2% for the next 5-year period. Now, most of that is after the first half of 2021. So we're expecting things to be relatively muted in the first half of this year, but then to see the recovery, and we know why that's going to be. That said, I would say the likes of the industrial market have already started the year with a bang. So I might well be raising those forecasts. I know our research team are looking at that at the moment. So as a headline view, over 5% per annum. But the main theme to draw out is one of continuing difference in performance between retail and the other markets. So we still expect retail to be subdued, whereas the likes of the build to rent residential market and the industrial market are still expected to sort of lead the pack, as it were, with returns of over 6% per annum. We see the leisure market as being one that has suffered significantly last year as a result of the closure of the cinemas and the restaurants, but that is one that we think will come back. So again, a likely muted first half of the year, but one that should see some strong recovery. And in terms of income and capital growth, the expectation is that of those returns, roughly 5% would be expected as your income return, with the remainder being just under 2% being through rental growth and capital value growth. But that's very much spread over a 5-year period.
Absolutely. Which obviously, it's important when you're looking to piece together a portfolio, the expectation of those returns. And property has been under pressure, but hopefully that's behind us. And again, as we discussed beforehand, not necessarily on property, but just on the broader and wider world, we've all come through this. We've all come through with, some with scars, some without, but hopefully we'll all take very valuable lessons from everything and just push on. That's a bit of positivity for a Thursday when I'm recording this. So we'll see. Absolutely, we'll see where we go. Matt, as ever, it's an absolute pleasure to talk to you. The fund performance has been fantastic. It's been excellent. Certainly, full disclosure. Matt manages our property allocation with our portfolios, and will continue to do so Thanks very much for your time today. Thanks very much for all your efforts over the last 12 months, and long may that continue. You take care, and I'm sure we'll catch up soon.
And you, thanks very much indeed. Take care.